Shit.
So
All
what
right.
are we doing like over here?
Basics.
We are studying about the income statement and statement of financial position. You all know the format of your income statement, right? What is the format of your income statement? Can you just tell me fast?
Revenue
Sales.
minus sales return minus
Huh?
cost of sales. Cost of sales में you will have opening inventory plus purchases minus
Opening
closing
inventory,
inventory.
which column you will write? Opening inventory, you will write in the second column.
Second column.
Plus purchases, for all the adjustment related to purchases happen over here.
First column, yeah.
Okay, so purchases mein what are the adjustments that are related to purchases?
Minus purchase return.
Huh?
Then there is
Add carriage
carriage
inwards.
inward.
Minus purchase return, then you will add the carriage inward.
Carriage inwards.
And
That's it, no?
No, there's less
less
goods for
goods
own
for
use.
own use.
Oh yeah,
Less goods for own use. Remember, the goods for own use will always be a part of the adjustment. Goods for own use is always given in the adjustment. The drawings that is given in the trial balance is not goods for own use. Always remember
Okay.
that. Okay.
Okay. So goods for own
Everything
use is only given in the.
only
It's only given in the adjustments. Okay.
adjustment. Everything that is related to purchases happens in which column?
First column.
Everything that is related to purchases will happen in the first column. After you do all the adjustment related to purchase, whatever amount you get, where will you put that amount?
On the second column.
In the second column. Then what will you do? You will do opening inventory plus purchases and you will arrive at another amount. Okay?
Miss, where's closing? There's no closing inventory.
No, then you will do after that closing inventory.
Yes, after that you will do closing inventory. That means you will do less closing inventory. Okay? After that you will do less the closing inventory. Closing inventory will go directly in the second column, and what you will get over here after minusing it would be your cost of sales.
Yes.
Are you with
Then
me?
total. Yes, miss. Then total revenue minus total cost of sales will give you gross profit.
So this will be your total revenue. From that you will minus your total cost of sales. What you're going to get is your gross profit. Are you with
Yes.
me? In the gross
Yes.
profit, you're going to add the other income and you will deduct the other expenses.
Yes.
Can you tell me what is the other income that you add?
Other
Commission
income.
receivable, rent receivable.
Something uncommon.
Something uncommon. Commission.
I said commission receipt.
Miss, will you put the provision for doubtful debts is positive? You put it over here.
Yes. So that is a decrease in the provision.
And profit on sale of asset.
Profit on sale of asset. What else?
Profit on sale of asset. What do you mean by that?
If you have sold an asset and you've received a profit, that will also come in other income. What else will be a part of other income? Discount received.
Yeah.
So if you have these items, do not forget to record it. So there are 4 things that you record in other income. What are the 4 things that you will record in other income?
Discount received.
Add
Profit.
other income.
Profit
Yeah,
for.
tell me.
Yeah, add other income. Discount receive. Adding profit from selling the assets, and commission received. Commission received.
And decrease in provision.
Decrease in provision. Okay, yeah, that
Decrease in provision, how do you get if your old minus new is
minus
positive?
new is positive. Yes.
If your old minus new is positive, then you write it over here. These are the unusual items which I'm doing so that you remember. Then what will you subtract?
Subtract other expenses.
Other expenses. Can you give me the list of other expenses which we normally tend to forget?
If we forget, then how can you remember it?
First is depreciation of assets. Okay, but you will take the amount only of the current year. What else? Can you help me, please?
Bad debts.
Bad
Bad
debts
debts.
negative.
And when you're doing
Old,
bad debts, what bad debts you will record?
old minus
Uh,
plus new.
old
Old
plus new
plus
bad
new.
debts.
When you're doing bad debts, you will record the old bad debts plus new bad debts. Then
Yes. Then
increase in provisions. Increase in provision for doubtful debts. If your old
yeah, okay.
minus new is negative, if your old
Yeah.
minus new is negative, then there is an
Negative.
increase. And
Yeah.
the other expenses which are normally there. Are you with me?
Yeah. Yes,
Yeah.
miss.
When
And
you're
miss,
adding
one
your
MCQ paper, miss, one MCQ paper कितने time का होता है? 1 hour?
when you're adding your other income and you're deducting your other so when you add the other income and you subtract the other expenses, okay, other income, everything that you're going to add in which column? Second
Then
column.
second column.
And other expenses, whatever you have, you're going to do it in which column? Second
Second
column.
column.
Only the total will go in the third column.
Okay.
So when you add other income and you subtract other expenses, what will you get?
Profit for the year.
Profit for the year.
You'll get the profit for the year. Are you with me?
Yeah.
Yeah.
This is the basic format of your income statement. Then you have your statement of financial position. In your statement of financial position, the first thing that you will have is what?
Non-current assets.
Non-current assets.
In your non-current asset, you should make sure there should be 3 columns. What are the 3 columns?
Cost,
Cost,
debt to
debt
date,
and
and
net
DV,
book value.
NBV.
Cost, debt to date, and NDV. Okay, you will write all the assets that you have, non-current assets. You normally forget motor vehicle is a non-current asset. Even
Yeah, it
goodwill,
is.
patent, trademark, copyright, it is non-current asset. Whatever
Okay.
cost is there, you will write it over here. Whatever D2D is there, you will subtract it from the cost. What you get is the net book value. Then you're going to make
Yes.
one line which is this through and through, and you will close the column over here.
Okay.
This is your net book value. Are you with me?
Yeah.
Yes.
Then there are 5 current assets that you write. What are the 5 current assets that you write?
Closing inventory,
Closing
trade
inventory,
receivables,
trade
minus bad
receivables,
debts, the
minus
minus
PDD and
PDD,
bad debts, cash in
Minus
hand,
new
cash
bad
in
debts.
bank.
cash at bank, other receivables.
Other receivables include 2 things. What are the 2 things?
Prepaid expenses and outstanding income.
Outstanding income.
Yes, very good. So your total non-current assets, the net book value, and the total current assets, it's going to give you what?
The total asset.
Total assets. Then afterwards, you start with your liability side. Always remember, assets have what balance?
Debit.
Debit.
And liabilities have what balance?
Credit
Credit.
balance.
Credit balance. In this, if you're doing a sole trading concern, then you will just have share capital
Yeah.
plus profit minus drawings.
Wait,
Are
miss,
you
could you
with me?
repeat ये किस में आएगा? Yeah, where will this come?
In this owner's equity.
Okay.
Owner's equity. So if you're
Yeah.
just a sole trading concern, you will have share capital plus profit minus drawing.
Minus drawings.
Okay.
Okay.
Then you have your
Okay.
non-current liability. Non-current liabilities are your long-term loans.
Yeah.
And then you will add your current liabilities. What are the current
Yeah.
liabilities that you normally have? Bank
Current
overdraft,
Bank
liabilities,
overdraft,
bank
trade
overdraft,
payables,
trade
other
payables, other
other payables.
payables.
Okay. So owner's equity plus non-current liability plus current liability is going to give you what? Your
Plus
total
Total
liability.
total
It's going to give you what? Your
total
total
liabilities.
liability. So this is just the raw format of income statement. Now let me go to the adjustments that you normally have. Okay, we will quickly see
Okay.
the adjustments that we have. First adjustment is closing inventory. What is the effect of closing inventory?
cost of
Closing.
sale and current asset.
Cost of sales, you minus it in the cost of sales and you record it as the current asset. Are you with me?
Yeah.
Yeah.
Closing inventory is always found in the additional information.
Yes.
If you have two figures for closing inventory, what will you take?
What do you mean by two figures?
Whatever is
Suppose
the
they
lower
say that
value.
your cost of
Lower
closing
value.
inventory is 15,000 and the
Yeah.
market value of the closing inventory is 14,000. So if you have
Yeah.
two figures of closing inventory, what figure will you take?
You'll take the
The
smallest
lower
amount one.
You will take the smallest figure. So two effects of closing inventory is
cost of sales and current asset.
cost of sales and the current assets. Are you with me?
Yeah.
Okay. Second, outstanding expenses. What is the effect of outstanding expenses?
Current liability and other expenses.
You will add it to the expense.
How?
Outstanding is also called accrued or due. What is it called?
Accrued or due.
Accrued or due.
Then outstanding income. What is the effect of outstanding income?
Well,
Current asset and other income. Add to other income.
Income, and it will be recorded in current assets.
Yeah.
Prepaid expenses. That means expenses paid in advance. What will you do?
other expenses and current asset, minusing it with other
You will minus
expenses.
it from the expense and record it in the current assets. Pre-received
Yes.
income. What will you do?
Minusing
You'll
with
minus
income.
it from other income and you'll add it to the current
Yeah,
liability.
Yeah.
Depreciation.
Income statement,
And
other
balance
expenses,
sheet.
and balance sheet debris, the non-current assets.
Add in the NCA second column. Goods for
Yeah.
own use. This is the goods for own use that is found in the adjustments. What will you do?
Income statement subtract from cost of sales.
Cost of sales and capital. Wait, owner's equity में आएगा?
And
Owner's
yeah,
equity
owner's
में goods for
equity
own
mein
use
you will
आएगा?
add it to the drawings amount. Now
Yeah.
tell
Yeah.
me about
Okay.
bad debts. How do you treat bad debts?
You
Bad debt.
minus the trade receivables in the balance
Old
sheet
plus
and
new. In the other
Yeah, old plus
expenses, you
new.
will write what?
old plus
Old
new.
Old
plus
plus
new.
new.
And from the trade receivables, which bad debts you will subtract?
The new
Trade
bad
receipt.
debts.
The
The
new
new
bad
bad
debt.
debts. Okay. Now provision for doubtful debts. What is the effect for provision for doubtful debts?
So if you have to do old minus new, and if the answer is in negative, it's going to go in other expense, and if the answer is in positive, it will go in other income, I think.
Okay. Only the difference will go. Okay.
Yeah.
Yeah.
From the trade receivables, you will subtract the new bad debts and you're going to subtract the new RDD. From the trade
Yeah.
receivable, you're going to subtract the new bad debts and new RDD. You will get the amount that is shown in the balance sheet.
Yeah. Okay.
I'm pretty sure the income statement balance sheet with adjustments is clear.
Yeah, it's clear.
Okay. Even the provision for doubtful debts is clear.
Yeah.
Yeah. So.
Okay, fine. Now what we're going to do is partnership account. In the partnership
Okay.
account, there is one extra thing that always comes. What is that extra thing that always comes?
Interest on loan.
Interest on loan given by the partners. So the
Yes.
partners are going to pay, the partnership firm is going to pay interest on loan. Interest on loan is how much percent?
If nothing is mentioned, it's 6%. If there's something in terms of agreement it's mentioned, so it depends on the partnership form or the
Yeah,
partnership
so
deed.
the partners are going to give the partnership firm what? Interest on loan.
Yes.
This interest on loan is treated as other
Interest on
expenses.
loan, other expenses in the
This
income
interest
statement.
on loan is treated as other expenses and you're going to record it in the income statement. Where are you going to record it in the
Income
Income.
statement.
Okay.
And Miss, will interest on loan be in adjustments or
It can be anywhere. It does not really
it can be
matter.
in the
Okay. So
okay.
in partnership account, tell me the financial statements that you will make.
In the partnership account, you make
Income
the income
statement,
statement,
profit and loss
profit and loss
appropriation,
Income statement, profit and loss
appropriation account,
capital
appropriation
account, and
account,
balance sheet.
profit and
a
loss
capital
appropriation
account,
account.
Current account.
yeah,
Okay.
current account be
Now, when we
current
are talking
account,
about capital account or current account, we have two methods to make capital.
the
What are
fluctuating method and the
methods to
fixed
make
method.
capital?
Fluctuating method and the fixed method.
So the first method is the fluctuating method to make capital, and the second
Yeah.
method is the fixed method to make capital. Are you with me?
Yeah.
Yeah.
In the
Yes.
fluctuating method, the capital account balance fluctuates.
Yes. It means it changes.
Yes. In the
It doesn't
fluctuating
stay the
method,
same.
the capital account balance fluctuates. It changes. So we are going
Yeah.
to prepare how many capital account?
There are only one capital account in fluctuating.
So in the fluctuating method, we are going to make only one capital account. Everything that is there in our capital account would come over here. Can you tell me what are the things that would be there?
In the capital account,
Yeah.
there would be capital, there would be interest on capital.
Where would the capital be?
Okay, capital would be on the credit side, interest on capital would be on the credit side, and salary to a partner would be on the credit side, commission to the partner
Capital
would be
will
on
be
the
over
credit
here.
side. Yeah.
This could be the opening capital.
Yeah, opening capital, balance BD.
Then cash
Uh,
bank is what capital?
cash bank is the additional capital,
Capital.
Additional capital. Then
and
interest
then
on capital.
interest on capital.
Then anything what partner receives.
Yeah,
Anything what the partner is going to
partner
receive from the
receives.
firm. What else?
Yeah,
So anything what the partner receives, okay, will come on the credit side.
yes.
Okay, what else would come on the credit side?
Like salary to partner A, commission to partner B,
Salary
and
to
the share of
partner A, commission to partner B. What else?
and
There is
the share
one
of profit.
unusual item that always comes over there. What is it?
Share of profit.
Sorry?
Share of profit.
No.
Unusual item where, miss?
One unusual item in the capital account.
Interest on loan.
No,
Interest
it
on
doesn't come
loan.
in.
Lovely.
Right.
Interest on loan is one unusual item that comes in the capital account. And where
Yeah,
will
okay.
the other effect of this interest on loan be?
In the income statement.
In the income statement. So interest on loan is one thing that comes, it's an unusual item. It will come on partner's capital account credit side and it will come on the income statement. Are you with me?
Yeah, yes.
Okay. On the debit side of the capital account, what do you have?
Drawings, interest on drawings.
You have drawings, you have interest on drawings. What else you have?
What else? Like income, like
You will
towards the
have
firm.
the closing
Closing balance.
capital also on the credit side.
Yeah. Yeah.
Okay.
And yeah,
So
there would be loss if there is loss.
if there is loss. So
Yeah.
in the partnership account, we first make the income statement. In the income
Yeah.
statement, there is only one thing new is the interest on loan. Whether the
Yeah.
question tells or does not tell, you will calculate the interest on loan. If it tells, you will calculate at that percent. If it does not tell, 6%.
Yeah, 6%.
This is
Okay.
called profit for the year, or I could say it is called profit before appropriation
Appropriation.
or profit after interest on loan. This profit
Okay.
you will take to the profit and loss appropriation account. Then you will
Yeah.
add the income from partner, like whatever you receive from the partners. You will
Yes.
deduct the expense towards partners. Whatever you pay to the partners, you will get net divisible profit or residual profit.
Yeah. Yeah.
This you will share among the partners in their profit sharing ratio. Sometimes they
Okay.
won't give any profit sharing ratio. So if they are not giving you any profit sharing ratio, you will divide it equally. Okay.
Okay.
Sometimes they will give it in the upper part of the question that they share
Yeah.
they share profits in the ratio of the capital invested.
Yeah.
So
Okay.
in that case, you will have to find the ratio of capital invested.
Capital, then you'll do it.
Yeah. Okay.
Okay. Now,
Yeah.
next, you make the capital account. Capital account as per the fluctuating method, you will make only one capital account where the opening balance would be different from the closing balance. That
Yeah.
is why
Okay.
we say the balances of the capital is fluctuating. Are you with me?
Yeah. Okay.
The other method, which is very common in the papers that they ask you, is called the fixed capital method. What method it is called? Fixed capital method. In the fixed capital method, what you do is you prepare one capital account and one
Okay.
current account.
Yeah.
In the capital account, you're only going to record these two items. Which
Yeah.
two
Okay.
items?
Balance BD, cash bank.
You're only going to record the balance BD and cash bank. That means you're only going to record your opening balance, additional capital. That is
Okay.
it. Nothing else will
Yeah.
come in the capital account.
Okay.
Whatever, everything else that is there with you, like the drawings, interest on drawings, interest on loan, interest on capital, whatever is there, it will come over here. Where?
In the current account.
In the current account. So your
Okay.
capital account, which was over here, it gets splits into two parts. The
Yes.
first part, you will have only the capital account balances, and the other
Yeah.
part, everything else will be there.
Yes.
Okay. Then they will ask you to make a balance sheet. What will they ask you to make?
A balance sheet.
A balance sheet. Like if you see over here, this is the current account. 1 minute. Now, if you see in this
Okay.
question, I am posting over here in your revision worksheet only. This is the question where you have two capital account balances. Can you see?
Yeah. 50.
Yeah.
Can you see it?
Okay.
Yes.
Yeah.
Yeah.
So you have a capital account, you have a current account, and
Yeah.
they've asked you to make an appropriation account, and at the same
Mm.
time they have asked you to make this account. Which account? Balance sheet.
Yeah. Balance sheet.
What account they have asked you to make? They have asked you to make an appropriation account, and they have asked you to make the balance sheet. Now in
Yes.
questions like this, when you're going to make the balance sheet,
Mm.
how do you make the balance sheet?
Like you're just gonna add the NCAs.
You will have
No.
the NCA, you will have your
Yeah.
CA, it will
Yeah.
give you your TA. What is TA?
Total
Total
asset.
asset.
But in your liability side, you will say it is financed by what
Okay.
account? It is
Capital
financed by
account.
capital account. You will
Yeah.
underline or put two semicolons next to this capital account, and you will
Mm.
write the names of the partner, Preeti and
And
Paisley.
Paisley.
Are
Okay.
you with me?
Yes.
The
Yeah.
amount that Preeti is getting is 100,000. Amount
Mm.
that Paisley will be getting is 20,000. You please
20,000.
see in which column I'm doing the total.
Second column.
First column.
Mm.
Okay. In the first column, I'm doing the total. This is the first column, second column,
Mm.
and third column.
Okay.
I'm doing the total in the first column. And this
Yeah.
total
Okay.
I'm writing in the second column, it is 120,000.
Yeah.
Are you with me?
Yeah.
Yes.
Then I'm writing the current account. I'm highlighting the current account. And here,
Okay.
I will not write this balance. I will not write 7932. I will have to find out the balance. Find out new balance. How will you find out new balance? Can you tell me, please?
From the current account?
You will make a current account. You will make a current account and you will find out new balance. So whatever is the current account balance, Preeti Pasley, you will make the account. Are you with me?
Yeah.
Okay. Yeah.
Okay. Now over here they say both the partners have a credit balance.
Yes.
But remember, when you're closing the current account, it can have any type of balance. Any partner can have a credit balance, any partner can have a debit balance. So when you're
Yes.
closing the account, be very careful.
Yeah.
Okay? When you're closing the account, be careful.
Okay.
Okay. Suppose I say, just for an example, I say the current account balance of Preeti is positive
Yeah.
6,000. That is, it has
Okay.
a credit balance. Okay?
Yeah.
Liabilities have credit balance, so I will say Preeti's account has a credit balance. And
Yeah.
I get to know that Paislay's current account balance is a debit balance.
Yeah.
Debit balance means the debit total was more.
Yeah. Okay.
And I get to know that Paislay's debit balance was 500. So what will I
Acha.
do? I will put this figure in bracket.
Hmm.
I will get the figure after deducting 5,500. And then
Okay.
I will total the capital account and the current account and write it over here.
Okay.
Are you with me?
Yeah. Okay.
This
Understood.
is the only new part in the balance sheet of a partnership.
Yes.
Then you will write the non-current liabilities. Then you will write the current liabilities. What could come in current liabilities?
Current liabilities,
Bank
uh,
overdraft.
trade
Trade
Is
payables.
payables,
debenture a liability?
other payables. Sorry?
Is debenture a liability?
Debenture is a liability. It's a non-current liability.
Okay.
And then you will continue your balance sheet the way it is. Are you sure you
Hmm.
all are with me?
Yeah.
Yeah.
So this
Okay.
is something different in the partnership account.
Okay.
Now let's talk about this petty cash
Oh,
book. Or you can tell me what are the different types of discount that you have.
Two are there. One is cash discount, one is trade discount. Cash discount is when an amount, the amount is settled and the supplier gives a certain percentage of discount to the buyer to encourage them to pay sooner. Then trade discount is usually given on bulk purchases so that the seller can encourage the buyer to keep buying from the same brand.
Okay, now listen to me. If I'm making a cash book, I will have a discount allowed column on the debit, a cash column, and a bank column. Are you with me?
yes.
And a bank column. Okay. So I will have 3 columns. So in this cash book, this will be on the debit side, and on the credit side, I will have a discount received column, a cash column, and a bank column. So when I am making the cash book, the amount that I write in discount allowed, it will be cash discount or trade discount.
Cash discount.
Cash discount. Okay. Just remember this part that in the cash book, the discount that you record, where be it the discount allowed column or be it the discount received column, it will be which discount? It
Cash
will be the
discount.
cash discount. Second thing you should remember, you allow discount when you receive money. You receive discount when you pay money. Are you with me? When you're going to receive the money, somebody is not giving you a lot of amount and is telling you, please do it in full settlement. So I have to allow a discount.
Okay.
And when I'm paying money, I will also tell someone, this is I'm paying you and this is the final settlement that I'm paying you for. Final settlement. So I will receive a discount. So whenever the words
Okay.
full settlement or final settlement is there, full settlement, final settlement, or in settlement is there will be compulsorily discount allowed or discount received. Are you with me?
Okay. Yeah.
Are you with me?
Yeah.
Discount allowed is your expense and discount received is your income.
Income.
Petty cash book. Why do I prepare a petty cash book other than having the main cash book?
To record the small petty transactions of the business, which are like day-to-day expenses.
Reduce the number
Okay,
of
and
entries for the main cash book. Reduce the
yes.
number of entries for the main cash book.
Okay, what is an impress system?
An impressed amount is when every month a certain amount is given to the petty cashier that is supposed to be spent, and by the end of the month, the amount that is left, you add the remaining so that it goes back to the impressed amount.
Okay. What is a journal entry to restore interest?
Petty cash, debit, cash credit,
Yes. So the
cash bank.
journal entry to restore interest is petty cash book. I will write it on the debit side, and money will go out from the cash bank. So I will do cash bank credit. Are you with me?
Yeah.
If the question tells you that you have to make the petty cash book and cash book both, so when you're restoring interest, you will write it on the debit side of petty cash book and the credit side of cash book. Okay. If any item is appearing on the debit side of the petty cash book, what does it imply?
Debit side of the petty cash book means that you've received the money.
It implies that petty cash book is debit. If any
okay.
item is appearing on the debit side of the petty cash book, it implies that your petty cash book is debit. So the other account will automatically become credit. Are you with me?
Yeah.
See,
Yeah.
for example, you have some columns like amount received. You have some columns like details. You have some column like total paid. And then you have some expenses. I'm just putting two expenses, cleaning and sundry. And I'm putting ledger. Okay. If any amount is written over here, 33, and in details it is written postage. So this item is on the debit side of the petty cash book. Can you see this? So it implies that petty cash book is debit. And they will tell you how will I complete the double entry for this transaction dated so and so. So I will credit postage account. Are you with me?
Yeah.
Okay. If suppose they're saying I have Abdul Rahim over here and total paid is 17 and in the ledger it is 17. Come on, they will ask me how will I complete the double entry of the transaction dated second.
Would you add the 17 in the amount recorded section?
Total paid and ledger.
Yeah.
Everything that I record on the credit side of the petty cash book comes in two columns. One in
Yeah.
paid and one in the respective account. My main
Yeah.
question is, how will I complete the double entry of the transaction dated second?
Dated second.
So you have to see over here. This transaction is appearing on the credit side of the petty cash book. Yes
Yeah.
or no?
Yes.
Yeah.
This transaction is appearing on the credit side of the petty cash book. So I would say petty
Yes.
cash book is credit.
Yeah.
So I have to complete the double entry. So I will say Abdul Rahim debit. So other account is automatically debit.
Okay.
So if anything appears on the debit side of the petty cash book, it means petty cash book is debit. Other account will automatically become credit. So when I'm completing
Yeah.
double entry for this one, I will say postage credit.
Yeah, postage will be credited. Okay.
And when I'm completing double entry for this one, I will say which account, this is petty cash book credit. So which account debit?
Abdul Rahim debit.
Abdul Rahim debit. Are you with me?
Yeah. Yes.
Everyone for sure?
Yes.
Okay, fine.